Well, as the yield curve moves deeper into inversion, the Fed soldiers on and pushes back on easier financial conditions. We see the US dollar finding a few friends just off that 50-day moving average, and equities march on higher. It's all going on in the trade-off. Well, hi, ladies and gentlemen. My name's Chris Westy. I'm head of research here at Pepperstone. And I'm going to be joined in a second by Blake Morrow from Forex Analytics. And we're going to be discussing and navigating all the factors that go into the global financial markets and trying to make sense of what's going on with some trading views and some ideas along the way. So I'm going to bring Blake into the program. Blake, first of all, mate, we've sort of been focused on a certain plane journey going into Taiwan. There's been lots of memes going on around about, a certain Pelosi capital buying puts and then closing them out and buying calls. And the market seems to have got along for the ride. How closely have you been watching that one?
Well, we've been watching it pretty close, Chris. I mean, this market's been melting up, and I have to assume that they're closing out calls as we speak. So
there you go. I think we'll be talking more about that situation going forward. The other one, of course, is congratulations to the England women's soccer team, the Lionesses, who won the European Cup against Germany the other day. Interesting one there, because next year we've got the World Cup playing through, and now women's football in the UK has come front on stage. We now have a successful team to really go behind and support, so the nation's behind that. We will be playing the USA, as the sort of favourites to go into that one next year in August. I think the US are paying about $3 or about $6.50. So England versus US women's showdown in the World Cup next year. It's going to be on.
It's going to be on like Donkey Kong. I can't wait to watch that.
That's good, mate. It's going to be fantastic. Anyway, let's go back inside the markets. Let's have a look at some of the factors that are making news. Let's go to Topical Funder. All right, soccer aside, football aside, I want to talk about sentiment. It's a great one to sort of digress and make sense of where we are at the moment, because, you've seen a lot of, obviously, concerned rhetoric from China around Pelosi touching down in Taiwan. We've seen certain data points showing, concerns around a recession. Some other points saying it's probably not so bad. Things like the ISM services weren't so bad. The durable goods were up 2%. But the yield curve's obviously screaming recession, and you've got 2s, 10s in recession, in deep inversion. 5s, 30s look like they're going that way as well. But at the same time, equities march higher. Potentially, are we in a Goldilocks scenario now where bad news means that yields go down and rate hikes come out of the market, but good data means that effectively that the recession trade gets pushed back and therefore equities rally in any kind of situation? How are you reading broad market sentiment at the moment, Blake?
Well, since I just came off the heels of watching Stranger Things and living the upside down, for those of you that are Stranger Things fans, we are kind of like in the upside down right now. And you've got markets that are they're rallying on bad news. And you're right. And we've touched on this topic many times over the last several weeks. And we are in that regime where it's bad news is good news. Yields come down, the market cheers. I've been told by mainstream media that we're not in a recession, or it's been redefined or something like that, despite whatever the GDP numbers are. So, all is good here in the US. But jokes aside though, Chris, the market continues to climb a wall of worry. And I think a lot of people are trying to lean into the short side of this market. We've been, you and I have talked about, the S&P getting back to the 200-day moving average. That's still 100, 150 points away. I think the market still has further to go, as long as there's nothing that really derails it. But data does matter. And you know what? We have one of the biggest data points of the week coming up on Friday, which we're going to talk about here in a few minutes. So, it's going to be really interesting to see how the market reacts. I've been anticipating this big move higher that we've seen in stocks. And I think technically, as long as the S&P remains above 4080 in the S&P, there's no real reason to be on the short side. But yeah, you have to be a little concerned here. I mean, the markets we've bounced 14, 15% off the lows in the S&P.
Yeah.
I'm just talking about S&P. We're going to talk about other markets as well, but I don't know, Chris. It still looks like it could continue. How do you?
I wouldn't be fading. So the equity market, the dollar's a more simple beast now, Blake, because I think bad news is bad for the dollar and good news is good for the dollar.
Sure.
I think that's going to be the way it's going to be now. But the equity market's a different beast. I think now you got the VIX 21.9%. So that looks like it could probably go below the figure there. And your volatility targeting funds going in there, market makers are closing out their hedges. So I think let's see what happens with oil. If oil trades lower, I think that's going to be good for stocks as well. Obviously not the energy sector. But yeah, I think if you're taking the equity markets specifically, I wouldn't be betting against this one at the moment. The trend is your friend, as they say. So I think, I wouldn't be fading this at the moment. I think we still go further levels, higher levels here, unless we see, something really left of centre come out and derail that story.
I agree. And, you brought up a good point on the VIX, and I don't want to go too far into it because I know we need to move along, but, volatility is at pretty key support. And you're right. If it drops below the figure, I think that's the 20, the figure that is, that would signal that we're going to get some further gains in equities, I would think. Let's turn it over to China. And I want to talk about China in this week. We want to talk about what happened with your favorite person and mine, Nancy Pelosi, visiting Taiwan. It's obviously been a big deal for the markets, and the markets moved on this news. And Chris, I'm gonna ask you, and I'm gonna come back to this question on, does it really matter for us as traders, for us as market participants, as you as an economist, as you as a trader? Does it really matter to us about what happens with China and the U.S. and the tensions that have been building? But I gotta say before we do that that these tensions have been building, and it seems like we're getting close to, the precipice of it all. But the flip side of that is that China's Xi Jinping, I just totally mutilated his name, but he's going up for an election in 3 months. Chinese GDP is slumping. Does he need a crisis, a U.S., tension, crisis on his hands right now, just before he goes up for an election? And, but are these disrupted trade routes with the military exercises that are being held around Taiwan, are they going to disrupt the markets? When do you care about what happens with China and U.S.? Because the markets obviously brush it off this week.
Yeah, right. He'll win the next election and get his third term, the first time that's ever happened in China, as far as I know. And does he want to show a strong face going into that party conference? I suspect he does, and that's kind of keeping us on the toes a little bit. I think we're already seeing sanctions against Taiwan. We're seeing Taiwan assets, obviously under pressure. The Taiwanese dollar's being hit pretty hard. The TAIEX looks like it wants to roll over. Some of the semis may get it, pretty hard at the moment. But I think for a market participant, you've got to look at what is the likely scenario and what is the worst case scenario. For me, the worst case scenario is we were to see, some sort of military tension playing through and the US were to get involved. Hopefully that doesn't happen. But the thing for a trader is obviously any kind of moves in markets from that is not going to be a one-day affair, right? It's something that's going to go on for a long period of time. So I suspect that's not going to happen. I don't think we're going to see, military tensions playing through. But I do think that if you're looking at Taiwanese assets, I think there's further downside in them. You're going to be looking at shorting the TAIEX and some of the markets around that. I think there's going to be further sanctions played there. It's going to be pretty tough for some of the citizens in the country based on the sanctions that are playing through. But whether or not this spills out into global concerns in markets is obviously yet to be seen. But this is an event that now everyone is focused on. What is going to be the fallout? What assets are going to move on the back of that? And it's something that we have to assess as a I wouldn't say I call it a tail risk anymore. It is something that the market knows fairly well and that's on our radar. And obviously Pelosi has stoked that bear pretty strongly, right? So an interesting one. The other one was probably more close to home that we all know really well is obviously about Fed policy. We talked about this idea that bad news is good for, well, bad news is bad for the dollar. Bad news is probably good for equities and those sort of factors as well. But what we've seen is the names of James Bullard pushing back on market pricing for rate cuts next year. Calling the Fed funds rate up as high as 4% this year. We've seen Charles Evans coming out, reasonably positive comments or hawkish comments, should we say. Mary Daly, who's one of the more dovish members of the Federal Reserve, pushing back on expectations for a Fed pivot anytime soon. And I suspect that's still the case, that inflation is the name of the game. They're still very much after inflation, and they're prepared to go after inflation and something may well break on the back of that. And that's the concern that we have. So we're looking at that September meeting now. As you talked about last week, there's a lot of water to go under that bridge before that situation. But the market is pricing 60 basis points of hikes, right? So if you look at 50 basis points, 75 basis points, we're pretty much sitting on the fence. It could go either way at the moment. That's why these small incremental pieces of data are going to matter. So what the Fed have done is they've made it much easier for us as currency traders, in my opinion. You know, if we get bad US data, it's going to result in US dollar selling. It's not going to be this flood of rush to safe havens and that situation. So the Fed are going after inflation. They're not so worried about growth, not so worried about employment. It's still all about inflation. And they've been pushing back on these easier financial conditions. Is that how you're reading it?
That is, and you know, I do look at all these Fed governors and like Neel Kashkari was just speaking earlier today, and
yeah,
you know, those comments are moving the markets, and because they're slightly moving expectations one direction or the other. It is interesting though how, you know, we've talked about quite extensively over the last few weeks, especially yourself, Chris, about how, you know, the market's pricing in rate cuts going into 2023. It's going to be interesting to see if that continues. You know, the bond market has made some overreaches just this last week, and we've seen yields slump and then bounce back. And so, you know, I think that the markets are on edge here. Every single piece of data is going to matter. You know, next month we've got the in between Fed meeting, Jackson Hole Symposium that obviously everybody's going to be paying attention to as well.
Yeah.
And in between that, we got CPI next week. That's going to be a market mover. NFP on Friday. I'll tell you, it's jam packed, and we have to be on our toes as traders. Yeah. And you're right though. Currency traders, we have it a little easy.
Well, I'll tell you what I think. Right. So the market pricing of rate cuts next year, the way I see this, and my macro thesis is that, yeah, we've got this neutral rate, the so-called neutral rate, which is at 2.5% on the Fed funds rate. They'll take it into restrictive territory, and they'll get up to what we call the terminal rate. And what we see then is inflation will start rolling over. It should start rolling over. And what they'll do is they'll be able to take the Fed funds rate back towards a more neutral setting. So that terminal rate, the time we're in restrictive territory, matters. So I think that's really what the rate cuts are saying. They're not saying, oh, you know, we need to go and support financial markets. All it's saying is that we're going to take the Fed funds rate into a restrictive zone, and that restrictive zone can't stay restrictive for too long when growth is in, you know, real dire straits and we see inflation coming down. Eventually, they're going to have to bring it down to a much more equilibrium rate. That's all I'm seeing from market pricing, is that they'll go really into restrictive territory, and then they'll just ease it back when they need to into a more neutral setting. But ultimately, they're not going to cut to support equity markets like they probably would have done a long time ago.
Let's just cut to the chase. If you're a currency trader, keep buying dips on the dollar. That's what Chris is saying. There
well, we're saying, well, mate, I reckon, yeah, I think so, maybe.
No, I know that's, I mean, but really, if you think rates are going to continue to go higher, we're going to go up to a terminal rate, you probably want to be buying dollars on dips. And maybe that might even take us into this Friday with the jobs report. Let's talk a little bit about the jobs report and how you're going to trade it and how we're going to look at it, Chris, because this has been my view since the weekend, is that we're going to rally into non-farm payroll, which it seems like we're doing as far as risk assets go. But the market is really expecting the jobs report to start to show some signs of weakness, maybe as early as this July report. I'm not necessarily in that camp, Chris, and I'm going to ask you what you think is going to happen with the jobs report, but I still think that the U.S. economy from a jobs perspective is still quite healthy. And I wouldn't be surprised if the jobs report actually, you know, comes in line or maybe higher than the whisper number is. But
whisper number. You don't buy all that nonsense there.
It's the Fed. Oh, of course is a whisper number on the street. Everybody has expectations. Everybody's got certain expectations.
Yeah.
But that whisper number is their expectations, the streets. Anyway, I think I'm going to tell you just how I'm going to trade it is I'm going to be watching gold, because gold is in a very tight range between 750 and 1750 and 1790. Gold's going to show us which way the dollar goes, because if gold goes one way, dollar's going to go the other way. And you can trade it like as a parallel in the euro. I think the euro is range bound between 101 and 103. And we're going to probably be trading around 102, the mid range, you know, going into Friday. But that is my opinion on the markets, and I think a breakout is looming. How are you going to trade the NFP, and what are you going to be looking for?
It's difficult, isn't it? It's just one of those ones where I say, well, look, Blake, here's the outcome of non-farm payrolls. Can you guarantee you're going to make money out of it? And I reckon that's a tough one to say you definitely would, right? So I think for probably the easiest trade for me is the NASDAQ and the tech trade at the moment. So I think the market is looking at this kind of Goldilocks scenario. What's the Goldilocks scenario looking like? I think probably anywhere between, like, say, 150 to 250 on the payrolls would be good. I think they want to see a slight slowing of the pace of job creation. I think the market wants to see that. If it's anything above 400,000, I think equities could come under pressure. I think the tech could come under pressure. The dollar would obviously rally. And I think, the Fed are obviously happy to see a cooling labour market to play through. So if the Fed are happy, the equity market will be happy on the back of that. So I think at above 400,000, then, probably you might see some sellers playing through in the NASDAQ. The dollar will rally against the Japanese yen. We'll have to see what happens with that unemployment rate. That matters as well, as do average hourly wages. But I think the nirvana moment comes in if we were to get, say, the unemployment rate, it's 3.6%, wages cooling a little bit, and we were to get, job payrolls around 150 to say 250. We would say the labour market's cooling, but not cooling so much that we're really worried about a proper recession. So I'd like to see that, and I think then the market might think about it for a little bit, but then sort of soldier on and push higher in this move that we've been seeing.
All right. Well, again, I think we're going to queue off of these numbers on Friday, and it's going to give some opportunities for us.
You've heard some of the facts. I'm really interested about that gold view that Blake's got there. But let's go to some of the charts that are front of mind at the moment. Let's go to That's a Setup. I've been banging on about the NASDAQ 100 for most of the show now, so I thought it would be quite good just to bring up the chart and show you what we're seeing there. So you can see the oscillators in the sort of the lower panes there. We've got the 3-day exponential moving average minus the 8 days. So you can see that the 3 days pulling away from the 8 days. So that's kind of probably telling you something about what you can already see in price action there. But I'm using that as a sort of a momentum tool. You've got rate of change, 5-day rate, or 3-day rate of change at the bottom. And again, just another momentum indicator that I like to use that. But most importantly, we've broken through the 13,000 level. We do have a bit of downtrend resistance, which we haven't drawn on there at the moment. But like I showed you last week in Ethereum, which didn't work out at all. We haven't lost a huge amount of money on the back of that, but we saw a breakout. The problem with momentum trades, Blake, as we know, is that they are positively skewed. So you end up getting stopped out for quite a lot of small profits. But when they go, you end up getting these tail events where you end up getting 4, 5, 6%ers. So you're looking for small losses but big wins, and I think that's what you're looking for in the momentum strategy. So as a momentum play at the moment, we've got the breakout, we've got all the indicators working. I like this further higher until the rules tell me to get out. What do you think there?
Well, the one thing that you don't have on your chart, Chris, is, and you know me, I'm a big Fibonacci level looker, adder, follower, and we happen to be at the 38% retracement of the all-time highs to the most recent lows this last June. And so that's a big deal, because a 38% retracement where we're currently sitting at, if broken and your momentum indicators prove you right and it continues higher, I think a break above the 13,000, let's just call it 300 level, will put us closer to 14,000 on a breakout. So I like it, as long as we close higher by the end of the week. The one thing I'd be worried about is if we, for some reason, gave back all of these gains we saw this week at the end of at the end of the week following the jobs report. That would be my only concern. But I love how NASDAQ's leading the way, Chris. I like it.
Yeah, no, it's a good one. And obviously, if you look at the liability side of the Fed's balance sheet, they've started moving up as well. So in terms of reserves, and I think that's really good for the NASDAQ. So happy to be in this one until the market tells me to get out otherwise. So I think onwards and upwards as part of a momentum strategy. Obviously, the mean reversion heads out there probably looking at this another way, but from a momentum and trend perspective, I think this has got further legs here.
All right. Well, one thing that might actually help the NASDAQ, maybe not directly but indirectly, would be crude. And I want to point out, crude oil actually has a bearish breakdown of a bearish wedge. But what you saw like late last week or mid last week is you saw this breakout above that dotted trend line above the top, and that failed. And then that pushed us right back below 92 bucks, pushed us back below the 200-day moving average. And quite frankly, if we break below 90, the levels I'm looking is you got 86, then 83. You got two levels below that we should see lower levels. You talk about momentum trade. You know, we've been in this, we've been holding this support really all of 2022, most of 2022 anyway, and a breakdown below 90 is going to be bearish. And I like the fact that we've had 3 closing days below this 200-day moving average. We're making lower highs and then, you know, breaking through those lows. So what do you think here, Chris, with crude?
Yeah, I think it's another. I love the fact that you brought this one up, because it's been, you know, last overnight we obviously got OPEC coming out increasing output by 100,000, which is, yeah, probably the lowest increase they've ever done. And we also saw inventories build by over 4 million barrels. So again, that was we're expecting a draw there. So that's part of the reason we've seen it coming down. But yeah, I think this break is quite significant. I think you're right in that 200-day moving average. I think you're right in the $86 level to target. I think that's the first stop. And as a momentum trade, the fact that it's breaking this low, I think is really significant. That when it comes to support in the market, I mean, this is as big as it comes, right? This has been a floor in the market for months now. So if this builds, it could really go. But fundamentally, it's hard to really see it justify far below $80 because demand's still holding up. You know, I think it does suggest that, I think you're not going to see a collapse, but the price is really what you're looking at there. And I think this when it comes to support, this is about as significant as it comes. So yeah, 86 would be my target as well, mate.
All right. Well, you know, that's something I've been staring at, Chris. And even though you guys know I don't trade it, I definitely like to call it. So there you go.
I like to trade it, and I'm definitely compelled by your call. But we want to talk about euro dollar, because for me, if I bring up a regression channel, or drawn from the highs at the beginning of the year, around February time, and just draw a line of best fit through this. Of course, there's other different ways you can use a normal just price channel, but I've used a regression channel using 2 standard deviations, and you can see that it's been working beautifully within that regression channel there. So just, you know, people are fading it into the top channel and buying it back there. But what we've got now around 120, 170 is a ceiling on price there. So we've got a sort of outside day reversal yesterday. I haven't really followed through, but it really needs to break to that to get to the sort of 50-day moving average, into the top Bollinger Band, into the top regression channel. And we're just trading a tight range at the moment, the range that you talked about. So that's been really guiding my sort of dollar view, is this regression channel. And you can see something the opposite on gold. You can see the dollar index working in a similar channel on the way up. So it's really capsulated my world. How are you reading the euro at the moment?
You know, I keep looking at that I think it was a 2016, 2017 low that came in around 103.50. We can't even get our head back above 103. And so, I'm looking at it same way as you, is just we're in a pretty strong downtrend. You know, parity, a lot of people believe that, you know, that pro below parity, we're not going to be able to break that again. Now that we've held it, we're going to just go higher. But think about the fundamental backdrop behind owning euros, and I'm not a big euro fan over the dollar right now. So I still look at it as being in a pretty bearish trend, and until it gets above that channel resistance, which I believe comes in around 103.50 to 104 for you on that chart. You get above that, and then I might be singing a different tune. But for now, I'm still in the bearish camp, Chris. And again, it's against the dollar. You know, if we'll talk about the euro against other currencies here in just a moment, but against the dollar, I don't know how bullish I am. What do you think here? Well,
I think 102.70 is your line in the sand there. If you get a break of that, then we go into the 50-day and the Bollinger Band. Maybe we start trending higher again, and the dollar starts having its wicked way against markets. But right now, this is one for the scalpers, isn't it? You know, you're looking at that line 121.70 and just saying 102.70, and you're just scalping it against that level there. So I mean that seems to be the play. There's just picking up scraps on that market, but a break of that and it goes higher, and I'll be waiting for that break to transcend.
All right. Well, you want to talk about maybe a higher euro? Let's go over to the EURUSD. And this is, I brought this up for a few reasons. First of all, it's a risk barometer for me. Whenever the euro outpaces the Aussie, and if you think about that, if you want to buy euros over Aussies, that means you're probably squaring up a previous trade, which was short Aussie, long euro, or short euro, long Aussie. And so if you see a reversal of that really signals that we're seeing some sort of risk off. That means stocks have really peaked and they look like they're coming back down again. But this technical pattern is what we call in harmonic patterns, a cipher pattern. And since
Cipher,
like if you're in the Matrix or something, but it is a pattern that a lot of us do follow, and it's a confluence of like Fibonacci levels. And when they form around like the 78% retracement that comes in around 145.50, as long as we can hold above that, I think the risk is that we trade back towards 150. And I still think we're in a range and more of a bearish trend. But I think that from current levels, 400, 500 pip rally could happen. And that's what I'm looking at today. And I think that's a good setup for anybody who thinks that risk might come down and you might see stocks come under pressure. The Euro Aussie would be a long in that case. What do you think here, Chris?
Yeah, I'm not feeling it at all, mate, to be honest. I'm not feeling any vibe in this cross at this point. You know, we saw a couple of days ago, you know, markets trading up into tried to make a move up into 150. The sellers just smacked it straight back down. So, you know, we tried to make a move higher in Euro Aussie, and, you know, there's clearly supply into those high 149 levels. So it's just a choppy trade at the moment. So for me, as a momentum and trend guy, yeah, I do have a mean reversion sort of plays there as well. But from looking at this, it's just chop, lots of choppy chop. And I'm not feeling it. So, yeah, I need a bit more work on this one to go. I think if I was going to look at this one, I think, you know, you really want below 145.30 on the downside, a break through that, and this could have some legs on the downside. But for now, it's just chopping. Yeah, the buyers and sellers are having a little battle going on, and no one's really winning. So I think that needs to be resolved at this moment. So yeah, I'm not feeling it myself, but I'll take your Cipher. It's probably the coolest pattern name I've ever heard in my life. But I'll take that all day long. Anyway, let's go into the play of the day. Let's see what's going on there. Right, I'm going to start proceedings. I had a bit of a poor one last week on the Aussie dollar. It was looking like it was going on, but as we know with momentum trades, you take small losses and you take the big wins, and that didn't work out so well. So we've taken a little bit of a loss on that one. This week though, lumber. So lumber's a really interesting one because it's been this big macro trade. On the way up, it was the poster child of everything. It was inflation. The housing market was on full boom. You know, we saw obviously issues with supply chain bottlenecks, and the price of lumber just went absolutely skyrocketing. Yeah, we've seen since that point demand destruction really hitting home. House prices coming off. Yeah, interest rates in the US, 30-year fixed for interest rates going up sharply, up to about 6.04%. They've started coming off now. And obviously housing's been hit and lumber's come off with that as well. So look at this from a trend perspective, from a momentum perspective. This is doing everything right from the short side at the moment. Bollinger Bands are widening. We're breaking through lows. You know, the flow is there. We're looking for those April 2021 lows. So I think this traded from the short side is just fitting everything, but it's also really going to be the poster child for a lower inflation reading at the moment. So we're seeing, you know, the housing market looking like it's normalizing. Lumber should be on your radar there. I think this is trending beautifully, and I think it trades lower here.
All right. Well, Chris, it looks like, based on what I'm seeing right now, it looks like lumber is going to zero. For crying out loud.
Jesus. Yeah, right. Chop it down.
All right. Let's say I'm going to take you over to the sterling. And the reason why I want to take a look at the pound dollar or the cable, the sterling, whatever you want to call old Betty, some people call, is just because, you know, we got the Bank of England tomorrow. Now, I'm going to go into this, Chris, saying that I do not have a position right now. Yeah. However, I do think that the Bank of England, even though they are going to raise rates, they might have a dovish hike. And the sterling's sitting right on support at the 121 level. And I think we have to watch this channel support. And if it breaks through 121, I think it's going to open up a move back to 119. And you might be a buyer on dips in the cable, in the sterling. You might be that way, but there still is political uncertainty out there with who's going to be the next prime minister. I know people are going to have their opinions, but the Bank of England, they have to respond by raising rates. But they also have to be careful that they're teetering with a very, very weak economy. And I think a dovish hike might be in store for the Bank of England tomorrow. So we might be watching that sterling if it breaks through the 121 level. And the flip side is if it breaks above 123, that's a bullish breakout. And that would be something that every bull needs to be paying attention to.
Well, it's a fascinating one. It's tonight for me. I'm on the right side of the world. Liz Truss will get the next leader of the Tory party. She's got it in the bag, in my opinion. And she'll bring some fiscal support to the pound going forward. But yeah, we're not going to know about that. The Bank of England, though, 44 basis points of hikes being priced in for this meeting. We could easily get 25 basis points. I think we go 50, but you know, if they could easily see that. So 25 basis points when the market's pricing 44 basis points. We break to the downside of that channel. It's going to be a big one. It could get pretty lively for you. Anyone who's got pound exposures, do keep an eye on that. And also, if you get a chance, hit the like button. If you found yourself watching it to the end, you obviously like it. You know you do. And leave a comment as well. We'd love to hear from that. And we'll try and reply when we can and get back to some of those some really good comments that come through there. So great to have a community. Great to see some people coming back time and time again. We really appreciate it. We do. Our hearts are with you. We'll see you next week for more of the trade-off.